Okay, in this video I want to just focus in on what are some of the strengths and weaknesses of net foreign debt, and as well as foreign investment. Foreign investment is very different to net foreign debt. We're talking about, in this case, allowing foreign companies to operate in Australia, selling off our assets, these kind of things. So first of all, foreign investment, again, and it's a bit of a recap, is when there's capital flows from overseas countries investing in things like property or purchasing shares in Australia or establishing large companies within Australia. And then it can be split really into portfolio and direct investment, where portfolio investment is when the investor doesn't have any control over the company, they're only purchasing a small part, and direct investment is when they're taking over 10% and therefore have some controlling stake in the company. In terms of benefits for foreign investment, so again, we're talking about foreign companies, foreign investors putting their money into Australia. So the benefits are that, when foreign businesses come to Australia, it does provide jobs for Australians. It does help to lower the unemployment rate because these businesses, come to Australia. They produce on large scale, therefore they create jobs for employees. It also increases the profitability of other local businesses because these big multinational companies will use supplies from those other companies, so that will help to generate profits for them. They also bring new production methods, new techniques, and therefore that can help to boost productivity as well. So foreign companies are coming here with new ideas, better ways to produce. That's going to improve our productivity as well. And one of the big benefits from foreign investment is that they will pay company tax here. Companies that establish in Australia have to pay company tax like everyone else. They pay it at the rate of close to 30%, and therefore that helps the government to generate revenue which they can then spend on essential goods and services. In terms of the problems for Australia is that the profits are going to flow back overseas. So if we allow too much foreign investment into Australia, those profits are then going to flow back overseas. So while we still get to tax them in Australia, the actual profits will flow back to people who own the business overseas. It can also lead to a loss of identity for a lot of major Australian companies. So Vegemite, Arnott's, they're now all foreign owned, and all the profits are flowing back overseas. In terms of foreign companies, they often become multinational because of cheaper production costs or cheaper labour or lower company tax rates, but we'll talk about that more in the next slide later. So summarising some of the benefits of both costs and benefits of net foreign liabilities, so we're talking about debt and equity here, particularly debt, but even foreign investment allows us to invest at a greater scale. It gives us funds for infrastructure, whether that's via equity investments or via debt, so whether we're giving them an ownership stake in businesses or we're just borrowing money, it does allow us to spend money to improve our infrastructure, to boost our productive capacity. The Australian economy would not be growing as fast if we didn't have access to this debt and this foreign equity. In terms of debt, that gives us access to cheaper credit. So Australians' interest rates are often quite high, so by borrowing from overseas we get access to cheaper interest rates. Increased investment in Australia makes us more productive, which we talked about before. We're looking at investment spending, and that they will pay tax here, so the government will have money to provide essential services. In terms of some of the negatives of foreign investment, as I've said, if it's debt, then the interest is flowing back overseas. If it is equity, then profits and dividends will flow back overseas, which is bad. And because that's hurting the CAD, it can lead to an increased net foreign debt in the future. So even if we sell off our assets at this point in time, that can lead to a bigger current account deficit and then flow on to us having to pay more debt in the future or having more debt in the future. And that can hurt our credit rating and make it harder to get access to funds. I talked about the loss of identity in the last slide. Now this is specifically to debt. So debt is the main component of our net foreign liabilities. So it's important that you recognise some of the main negatives associated with net foreign debt. And some of the big negatives are, one, it's going to hurt the CAD because there's going to be more debit payments, so there's going to be more interest flowing out of the net primary income section of the current account. That's going to lead to bigger current account deficits and therefore debt continuing to grow. It can hurt our credit rating in the long term, and the problem with our credit rating falling is that overseas countries will increase their rates, so we'll have to pay higher interest rates on our debt. That could lead to potentially that they don't even lend us capital at all, so they don't lend us money at all, so we can't use that money to boost our productive capacity. Therefore the government doesn't have money for infrastructure and so on and so forth because of our lower credit rating. The other thing is that there's an opportunity cost associated with paying lots of interest, so the burden of high interest repayments can lead to less money for other areas like education and welfare, etc. And it can also lead to a depreciation of the dollar in the long term because money's flowing out of the country through the supply of the Australian dollar. In terms of public sector debt, so when the government's going into too much debt, that's all about the fact that they're going to have to cut spending. So they may have to cut spending on welfare, which will hurt low-income earners. They may have to cut spending on education or infrastructure spending. Other things they may have to do is raise income taxes or put GST on more products. So in this year's budget, they're thinking of putting GST on essential products, not just so like fresh fruit, bread, milk, those kind of things that they try not to because that tax can hurt low-income earners. So having a high level of public sector debt can hurt equity because it can lead to cuts in welfare, can lead to cuts in education, can lead to higher regressive taxes on things like essential services, and that's really bad for us in the long term. So there are a lot of negatives from high levels of net foreign debt. Trends in net foreign debt. Australia's net foreign debt has grown from being around 3% of our GDP to now being over 60% of our total GDP in 2016. So it is a cause for concern. There is a chance that we're going to lose our AAA credit rating. Most of this debt has been due to Australian firms looking for finance from overseas, so looking to borrow from overseas companies. It's also because of our high household debt levels, as well as the budgets running consistent budget deficits. Thank you.